Would you like to know how companies can reward shareholders? So stay with me until the end of the video. But before we go to the video, please subscribe to the channel and smash that like button. Hi. I'm Zhao and this is the Dividend Aristocrats channel. Today I'm going to talk about creating long-term value for us, the shareholders. Firstly, the most important thing for me is to think as if we own the entire company instead of thinking that we are minority partners, and, secondly, we have to think for the long term. Third, an isolated event will not influence a company's value if the fundamentals remain the same. In this video I will talk about the first two ways that companies have to create shareholder value. First, I will talk about the increase in earnings per share. As the name indicates, this value is found dividing the total profit of the company by the number of shares in circulation. It is very simple to understand. Let's imagine that a company has in year 1, $10,000 profit and has 10,000 shares issued, making the account very simple. The profit per share is $1 for each share issued. Nothing simpler to understand. Now I will try to explain the way that companies have at their disposal to increase earnings per share. The first way to increase earnings per share is to increase sales theoretically, because as we will see in the second way it is not always so, but if spending has risen in line with sales and the number of shares issued is the same, we will have a higher profit per share. I will explain better later. In the event that total spending grows faster than sales, we will have a deterioration in margins and as a consequence of a decrease in earnings per share, if once again the number of shares issued is the same. The second way to increase earnings per share is to increase the profitability margins of the company. In this case, as we are talking about earnings per share, the company can increase its net margin. Let's imagine once again that the company in year 1 has 10,000 shares issued. That year the company managed to sell $100,000 of its product, and that its profit after subtracting all operating costs and accounting and taxes was $1,000. What do these values tell us? That his net margin was 1% compared to the sales he had. It turns out that the company we envisioned is very well run and the CEO, despite not getting any bigger sales, is one of the biggest savers out there and begins to realize that employees are spending a lot of toilet paper, so as a good savior he looks for a place to sell toilet paper with the same quality but at a lower price. You can finally find and replace the usual renewable toilet paper with toilet paper that is much cheaper. Now with this cost reduction, the net margin went from 1% to 5%, yes, the employees even went to the bathroom a lot. So what about the profit? Profit has quintupled. If we were owners of some shares of the company, in year 2 the company had 5 times more profit to share with us. This is one of the ways to increase our earnings per share. The second way is something less logical, but equally mathematical. Let's again pull our imagination and think that the company in year 1 sold the same $100,000 of its product and that the net margin was 1%. And that in year 2 it also sold $100,000 of its product and its net margin continued to be 1%. So how does the company manage to increase our earnings per share? Doing one of the best techniques to increase shareholder value by buying back shares in the company, thus increasing the value that each share earns. I will explain. In this example the company spent the surplus of cash to make the repurchase of shares which caused the same net margin, the profit per share to rise 17%. This is the magic of the share buyback, and to increase the benefits, as opposed to the next way to increase shareholder value, the repurchase of shares does not pay tax. In short, to end this part, companies have 3 ways to increase earnings per share. Increasing sales, if costs increase on the line, making operations more efficient, increasing net margin, and decreasing the number of shares in circulation. Now I will talk about the second way that the company has to create shareholder value, which is the distribution of dividends. Companies can do 3 things with what they profit from. They can invest in the company's growth, they can reduce indebtedness, or they can take that profit and distribute it to shareholders. The percentage of profit they distribute can also vary, and one company can distribute 10% of profits and another can distribute 100% of profits. Taking the previous example, Company A is growing its earnings per share in the last few years at 15% per year, and needs to decide what it does with the money. If it distributes the profit to the shareholders, they will achieve a return above 15% with the distributed money? Probably not, and even if they do, if the company is expanding, how will it finance that growth if it distributes 100% of the profits? The company now has other options, which are the total retention of profits, which represents a payout of 0%, or it can distribute part of the profits to the shareholders. I prefer that even the smallest companies distribute with me a small percentage of the profit. This is clear if the company is financially healthy. Another example, we have Company B, which is a company in a highly stable but stagnant sector. Let's think it's a tobacco company, that growth is little or none and with a tendency to decline over the years. This company can't monetize retained profit better than we do, so it makes sense to distribute much of the profit to shareholders, and for this reason nowadays tobacco companies have an annual dividend between 6 and 8%, and it is not uncommon for the company that distributes 90% or more of its profits. They have nowhere else to grow, and have a manageable debt, so it is better to share virtually all profits with shareholders. In short, the distribution of dividends. As a general rule, high-growth companies tend not to distribute or distribute little dividends to shareholders. Companies with moderate growth tends to distribute a large part of their profits, between 40 to 60% of their profits, and companies with no prospect of business growth tends to have distribution rates above 60%. Attention here for excessive distribution rates. Above 90% has to be a very special situation, because even a company without growth and with little debt, should save some money for any eventuality. Thank you for watching. If you like and want more content like this or have any suggestions, leave in the comments below. Don't forget to subscribe to the channel and smash the like button. See you next time.